This week in economics on the 16th of May 2015. Numbers man here. We'll start with domestic news out of the state of Texas, and we'll end with the chair of the UK bank, Mr. Carney. He gave an in-depth report to the people there. This is inflation report, a press conference. He's the governor of the, governor of the bank there, and he gave some predictions. And I'll get to that in a minute. For example, predictions 3 months ago. Today I have written the second in what is likely to be a sequence of open letters to the chancellor there, and that's because of expected inflation fell to zero in March and 2 percentage points below the target and the lowest since the official CPI. As was the case in February, the single most important reason for low target inflation has been a sharp drop in energy prices. In March, oil was around 40% cheaper than in the middle of last year, and the price of petrol at the pump has fallen more than a tenth. Food prices also dropped, and sterling appreciated more over the past 2 years, has continued to depress import prices. That's appreciation, I'm sorry. If it depreciated, they would be in a different scenario. We'll get back to this. This is an inflation report. This was on the 13th, remarks by Mr. Carney. We'll get back to this. We'll go now to the oil prices and where they are. As example, in two Texas towns, they are roughly 38 miles apart in the remote plains of South Texas. Kearney City and Smiley provide two polar opposite glimpses into what life in a U.S. oil boom town looks like. This is from Bloomberg. The townspeople of Kearney, it's like nothing ever changed. Roughnecks pack into striped gasoline stations by the dozens to load up on Slim Jims Doritos at the end of their shifts. Giant drilling rigs dominate the horizon in all directions. This could have been written by Longsworth. The roar of tanker trucks and industry equipment is never ending. Up the road in Smiley, there's nothing now. No workers in the field, no rigs, no noise. In other words, it's peaceful. These two tiny towns, which blend together into a single portrait, illustrate the full landscape of shell oil industry across not just Texas, but also North Dakota, Oklahoma, and every other major producing state in the country. The reason drillers desperate to cut costs after 50% plunge in price are abandoning fragile fields and focusing their rigs on sweet spots that produce more crude. The oil fields in Kearney are gushing, and Smiley, nothing is happening there. They're drilling the heck out of those wells. Smiley's mayor, a retired oil field worker named Ellis Valencia, said in an interview from his cramped city quarters. Now we're at 50% of what we were a year ago. High grade, even the assessment and truthfulness, feels a bit optimistic. The tapering of new wells in and around Smiley has almost come to a total halt. According to data this is Bloomberg's intelligence analysts there, in November the area accounted for 13% of all new wells in Texas' massive Eagle Ford Snell patch. By March, it was down to just 1%. In Kearney, meanwhile, the percentage soared to 19% in the first 4 months of the year from 13% in 2004. This whole Shell oil thing here has taken on not only in the states that I named, but in states like Pennsylvania and Ohio. Greg Hill, he's from the Hess Corporation. He's the CEO there, put it recently, going to the core of the core in North Dakota's Balkan region. Hess managed to boost its production by 6% to 108,000 barrels a day in the first quarter by wrapping up drilling in the best spots, at the same time idling rigs that were non-productive. Marathon there, all the drilling is all drillers have taken down 941 rigs across America since the peak in October. That 58% of the total, yet U.S. output is forecast by the government to rise for a 7th straight year in 2015, underscoring the powerful effect of high grading. The Kearney City, you find some of the nation's top producers there. Marathon is there, of course, and various other workers from Schaumburg Limited, decked out in blue jumpsuits, man the rigs, handle the hydraulic fracking equipment, etc. To make Kearney shale so valuable is how dense, saturated with oil it is. This is rock, is basically what it is. Researchers at the University of Texas in San Antonio. Other fields elsewhere can contain bigger pockets of natural gas or take on more Swiss cheese-like formations that make pulling out the oil less reliable and much more expensive. That's to be remembered. This is an expensive process, while snail, you got to keep mispronouncing that word, is pretty attractive to drillers. When crude is at $100 a barrel, it's at $60 and going south, and little interest today in sub-$60 prices. West Texas Intermediate for June delivery lost 19 cents on Friday. We'll get to that in a minute when we do the numbers. Whereas the sweet spot lies, Texas Eagle Ford, shale, excuse me. The mayor there was holding a court at the City Hall earlier this week, leaning against a pickup truck of all things that has 540 residents in the town. The grocery store, home to the best burgers around, was empty just a few minutes before noon. The boom years was good to this Smiley, that is Villasaner said, but no longer is it good to them. It is different now than it was. The rig route only paints half the picture, while there's still rigs. Producers are amassing a backlog of unfracked wells as they wait for better prices. So basically 632 in the Balkans, and in Pennsylvania 401. This is cumulative backlog of wells in these various places since 2013. And they even have some in Denver. We're looking at some in Ohio. There, Eagle Ford, 1,250 there, and in Oklahoma, according to this graphic, 341, not as many there. So some of the things that are happening here, and they're holding, as they say, back on the production, down 61%. And the graphic here says it all. So this is the winners and losers. Retreat there, Kearney City share of Eagle Well competition. and has surged 20%, while Smiley is out of the game, so to speak. Let's get our other story here. I think we had another story from Bloomberg on the Greek financial situation, and then we'll get back to Warren Buffett. They are privatizing in Greece airports to satisfy the creditors. They're not privatizing the post offices. Let's go to Warren Buffett. Our major story will be around what the controller had to say. Warren Buffett, this is Berkshire Hathaway's his stock there. We'll make some commentary there. Basically, his favorite companies, Wells Fargo and International, IBM, and throw Coca-Cola in there. And U.S. Bancorp is also in there. No new stocks were added to the portfolio, which has shrank to $107.1 billion from $109.4 billion in December. They bought $1.62 billion and sold $1.11 billion equity overall. And their big four, of course, IBM, Coca-Cola, American Express. American Express is a company that is in much transition. They're trying to find new products for their credit cards. It's an old line company that is not having as much synergy today as it once did. They are moving to a lower end debit card products, those sort of things, to, as they say, shore up the profitability there at American Express. Whereas Coca-Cola, the sugary products, Reuters calls it, well, they're moving out of some of the sugary products and moving more to health-conscious things, such as green drinks, literally made of various green, like kale, collard, etc. Those types of drinks, they're going to that market, and to more juices. Some of their juices are more sub-juices that are sugary, but they are moving to that. They expect the executive pay structure has caused them a nightmare. This is a Coca-Cola. And with American Express, they lost, I think it was $48,000 in an antitrust in a ruling there, or that was 18. Anyway, this is a violated antitrust law, a court ruling there with AT&T. Nonetheless, there's a comment here from Andy Kern. He's the University of Missouri. Too many fund managers are more interested in seeing stocks to which they commit perform well in the short term. Well, Buffett has always had a long-term strategy, and it begs the question, and we'll get to that overall in other episodes as to the long-term companies and the long-term strategy, and where that will actually end up. In a nutshell, it is the IBMs of the world, especially Coca-Cola and American Express. Will they be around in 5 or 10 years? The graphic I saw the other day, that's I think 75% of these companies will not be around in 10 years. Or will they be merged, etc.? IBM is trying to move its technology to the cloud and other situations there. They are tinkering with their business model and solidifying Watson. No doubt in the big data field, Watson has its particular place. But however, IBM has to be very, very cautious of being what used to be IBM. In other words, living on the name, selling to enterprises that themselves are being either merged or they are being torn apart by pricing. Won't spend a lot of time with that, but basically, Berkshire Hathaway raised the stakes in Wells Fargo. Wells Fargo used to be known for mortgages. That's no longer the case. 2% to 470.3 million shares. IBM 3% to 79.6 million shares. U.S. Bancorp grew by 5% to 33.3